All right, hi everyone. Welcome to day 3 of this Tech Wizards event. Um, so just a reminder, of course, that um, these presentations are for educational purposes only. Trading is not suitable for all people, and please consult a financial advisor and only trade with money you can afford to lose. This event is brought to you by TradeOutLoud.com and TimingResearch.com, along with our co-sponsors OptionProfessor.com and MadHedgeFundTrader.com. And all of these sessions are being recorded individually and will be available on TimingResearch.com, as well as if you search for Timing Research on YouTube, Substack, and your favorite podcast app. So if you saw the schedule earlier, you would have seen Jake Bernstein was going to be our opening presenter today, but unfortunately he's not able to talk right now. So he was able to get Brian Latta to be here to be our opening presenter today. So welcome to Brian, and I'm going to go ahead and turn it over to him.
Thank you for that, David. And Jake is here. Certainly had to have a little bit of elective surgery to help his voice. Had some vocal fold therapy, similar to what Bon Jovi had some years ago. So Jake is here. He's on the mend. He's feeling better and should be back with us in full strength here within the next few days. But Jake, thanks for that. And as you can see in here, Jake frequently presents with me on the expansion contraction indicator. And as you can see here, there are several conditions that expansion contraction shows. It is a new and unique indicator that's a little bit different from what's been out there before. But first of all, let's go ahead and get into the normal disclosures. Information I'm going to be showing you today obviously requires all these disclosures, and I'm not going to linger on here too long because we're all used to the disclosures. But again, there is a huge amount of research. Expansion contraction is available at no cost for most platforms. It is objective. Obviously, how you use it may be out of our control. And just to be clear, both Jake and I have slightly different uses on the indicator. But here's a little blurb about Jake. Most everybody should recognize Jake. He's been around for 50 plus years. And this is some of the background on him. Now, he's been the publisher of market reports that major corporations and institutions around the globe use. And so, again, I'm a student of Jake's. Over 10 years ago, got together with Jake to learn about trading, and had been trading for almost 10 years prior to that. So, of course, I got together with Jake to learn coding and systems, program systems that are computer traded, and Jake had trading code on there. And so that's where I started to learn from Jake on coding systems. Have written the book on trading, and of course that is somewhat of the path that I've taken over the years. And of course started writing the book prior to that, but it's updated. It is at expansion contraction also for free, and you can reach either Jake or I on that site or for information. But basically, I like coaching and helping individuals learn how to do systems trading. Also, at this point, of course, we had a request to kind of talk about where we think 2025 will go. And for that, I'm going to post up from Jake's seasonaltrader.com website the normalized chart of the S&P 500. You should be able to see here that this data is from 1960 to 2025. So this is a huge amount of data. This is what we anticipate that the S&P would do over the last, 65 years of data. And so when the forecast for 2025 comes out, I'm still going to anticipate that we might see this pattern. And of course, if we don't, then we'll certainly know that something's different. So I did just post up a line chart of the S&P futures pricing. Way left, we're over here at the beginning of the year in January. Way right, we're over here in 2024. And as you can see, taking a look at the seasonal chart and popping back on what really happened, this year did behave as we'll call it statistically normal. I'm going to anticipate that if 2024 was statistically normal, that 2025, albeit likely to be an up year, will be less normal than 2024. I'm just going to assume that we won't see an exact repeat year after year. So the decennial or the fives, basically 2005, 2015, 2025, when we get there, they're generally up years also. So I'm still going to anticipate that this will be an up year. We will be able to track if the current market, let's just go back to the normalized chart, is deviating from what we had expect on the normalized chart, say below average or above average, then we can certainly continue to day by day update our forecast on what 2025 is going to do. But this year started off fairly similar, and we're going to assume again that we should see a continuation. So I have popped up an metastock chart showing expansion contraction indicator. Now, the very bottom of the chart is expansion contraction. I just wanted to show a basic chart on here initially that shows that there are buy and sell setups on the chart. I do plot B's for buys and S's for sells. So I do joke about liking to have a lot of BS on my chart, but that's not 1,000 indicators. That's the minimum necessary information for us to make a decision. And this has actually been systemized, as you can see, since it's been picked up by Metastock. They've also created a advisor on here that will show all of the different conditions that this indicator shows. Now, this is new and it has been around for the last few years, and it is getting picked up by chart services, but quite simply, expansion contraction is completely different from most indicators. It is defined as non-lagging in itself, since most indicators like moving averages, RSI, stochastic, default type indicators are generally lagging because they need many bars to plot one value on the chart. Expansion contraction measures data on every bar, and it's using Jake Bernstein's moving average channel to identify how fast is price moving up or down through the range defined by Jake's moving average channel. So expansion contraction also identifies a second measurement. As it says, it's a trend filter. Together, we can see short-term moves of price up or down, long-term trends up or down, and that helps us identify clear setups on the chart. And on here, as this also says, expansion contraction will mark every bar or candle if you're using those with the current condition. As you can see, strong up will be identified by darker green bars. Weak up, light green bars. A weak up condition, for example, would be where price is short-term down and long-term up. And so, again, I'm assuming you can read this much faster than I can go through, and I'm not going to reread everything on here and just in order to save time. But as you can see, it is a multi-indication indicator, long-term and short-term. And the second component here is that expansion contraction will also measure strength. It's using what we'll call a normal range. Now, standard deviation, mathematical term, I want to keep this really simple. So if we just know what the normal range is, we can identify if we're above normal or below normal or just trading normal on that. And it does require a lot of data in order to do that, but it will show horizontal levels of expansion contraction where it's weak or strong. And if this makes sense, expansion contraction is non-lagging. It'll help us identify whether the trend is up or down, whether the current swing is up or down, and whether or not we are strong or weak. So in essence, that says you'll always know what to do with expansion contraction. At the right end of the chart, you'll always know what the conditions are. Are they strong? Are they weakening? Have they reversed? And we've created some trading rules on there, where to get in, where to get out at a loss, when to take a profit, following Jake's setup, trigger, follow through methodology. We just want to make sure, right, that we have the entire process of getting in and getting out predetermined, ideally back tested over time, and then validated, hopefully by third parties, and then forward traded to see if it continues to be consistent. into the future. And all of that process I learned from Jake initially back in 2014 on how to create trading systems that are consistently profitable, and basically has helped me be more consistent in my own trading. So we'll say on here, as this is mentioning, we're going to get clear entries. There will be a B for a buy, at least on Metastock. Other platforms which may not have the ability to plot the BS on the charts, pun intended, on that, may also then at least show markers on that. But as you can see, we've got green bars, darker and lighter. We've also got red bars, darker or lighter on here, and it should show us pretty ideally on there, again, where to get in, where to get out at a gain or a loss in a system trading type process. As I can again mention, must be back tested. If you're going to trade a system and it hasn't been tested in the past, what confidence are you going to have to trade it in the future? And I'm going to have to say, since you're all alone for the most part making your own trading decisions, your own confidence in what you're doing is critical. So ideally, you've got proof. So as I said, at least in Metastock, they've wrapped it all up into a nice, neat little expert advisor. Other platforms, as I said, we've got available. We're shown at the beginning of the first screen, and basically are available for most of the major platforms for free. So again, I'm going to try to describe this expanding up on expansion contraction here a little bit, or at least making it bigger. You can see I've labeled short-term swings, and that's based on the green line and the red line. So two components of this, the lines, and the second component are the clouds or the cones in the background, as Jake likes to call them. And you can see it's either green or red. So the short-term swings with the red or the green line, that will be where we're either a lighter green or a lighter red in this case. And when we're in a counter trend or corrective type pattern, and in the direction of the trends, you can see here after the buy setup and of course the long-term up arrow, we had turned both short-term and long-term bullish. That triggered the buy setup. We'd have this at buy a market on close are some of the rules on here, and we're using clear rules on where to get out at a loss and take a profit, as I said, that have been tested. So when we see the arrow pointing down on here, we're going to see we're in a period here where the red line has gone above the green line, which is going to then say we're in some type of correction. The trend is still up. That's why the bars are green. On that, the shading is a bit hard to see here, but again, at least if we're in the lighter green bars, we know we're short-term bearish, making some kind of downward correction in a longer-term trend up. So as you can see, we had the strongest part of a move up, all green, traded beyond a price extreme, made a sideways to slightly bearish correction, continued the trend on here. And as you can see, the green line went back above the red line, and we still have the green cloud on here. So we have trend continuation, and even lighter Bs and slightly smaller that would show a continuation setup. So we've not only got the original setup on here when we first change from downtrend to uptrend, but we also have additional setups to help as an add-on trade to get in and add to your winning trade if you're already in. If not, we have those as, say, additional setups, allowing you to potentially get in at the beginning of the trend or add on 1, 2, 3, 4, 5, 6, 7, 8 type add-on trades in there after a correction and price starts to continue to the strongest part of the move up. We're going to see the markers on here. So you see we had a long-term uptrend with multiple corrections. Should be clearly easy to see on that. And then, of course, towards the end of the trend, we did to start to see that the market turned more bearish. We did get the long-term, short-term crossover, created some sell setups, and we'll be sharing the full set of rules on this also. The rules that are based, or I should say, the rules that have the results that I will be showing here in a little bit while on some of the trades for this past year and for the past few years. So, of course, you can see then again towards the end of the chart, and we start to see a upswing in a downtrend. We're still trending, and red bars or light red bars, which after a correction in a downtrend does turn bullish enough here for us to give us a long-term, short-term buy trigger, and prices had gone higher after that. I'm also going to show range expansion and contraction with the indicator at the bottom. You can see where either the lines or the cloud or cone in the background expand and get wider apart. And expansion is the strongest part of a move up when the green lines are expanding above the red line, and the green cone or cloud in the background is expanding. It's showing us the strongest part of a move up. So I've labeled that with some green arrows showing this general pattern was an expanding uptrend with some contractions in here that would have been the correction period. And then another correction here, which is contraction, and showed the correction back lower and maintaining the bullish pattern from October, in this case, of 2023, all the way up to the first, sell setup that would fill, which was all the way into March of 2024. So the thing about this indicator is that it can give us some long-term trends. Some of the underlying statistics on here show that when expansion contraction starts to trend up or down, the average duration on a daily chart is typically 24 to 30 days. Now, that being said, could it be less? Yes, it can be. That's obvious. We could have a 1-day sudden reversal where we can see a weak sell setup occurred and then a buy setup and then turn right and around 2 days later with a sell setup. So you want to realize that we will get some indications that may give us a relatively short-term small loss, but that's normal with all indicators. So in going through the tradable characteristics, I'm only labeling a few of them here, including divergence on that, but to be clear, there are over 30 tradable conditions with expansion contraction. And we're only currently touching the surface of what we'll call that the higher probability, longer term patterns on here. So when I am talking about divergence, as we can see in here, where price highs continue to make new highs over time, and we go down to see expansion contractions, widest range starts to contract, a wider range is lower, and then a wider range is lower in here. So we can see generally expansion contraction is contracting over that time, and have coded this with some of Jake's rules to be able to trade divergence using expansion contraction or any of the other several methods that Jake uses on the trading to divergence rules. So we just want to be sure that the indicator we're using is not lagging. Ideally, we're using leading indicators like Jake's recommendations on using the commitments of traders. Personally, I'm going to say if you're not using seasonaltrader.com, you're missing out on what I would still consider to be the best resource for using seasonal trades. There are others out there. My assumptions are they're after the fact and might have modeled on what Jake does, or even potentially use his data. But Jake was the first and the original, and seasonaltrader.com is a fantastic resource for that too. And we want in this educational session here today to make sure we're giving you just as much information that you can use immediately. And again, Jake and I are doing coaching, group coaching on that, and that is available. I'll pop up some information a little later on how you can participate on that if you qualify, because it is a interview type process. But here on the divergence and even the short-term breakouts on here, again, I'm just showing a bearish divergence where price is generally making new lows, and the indicator is contracting over time. And when we get a trigger, this particular one happened in mid-April, we'll have to say it came within, I think, about 15 or 20 cents, if I recall, on stopping out on a divergence trade, and then managed to pick up the move on here. There was a secondary divergence that would have picked up in April, at least. May not look good to get in post earnings and a breakout on that. But as you can see, even on that, Apple traded significantly higher. So on that, I'm going to pop up on here on the Metastock charts because we want to see, well, if we had some buy setups or sell setups, what happened. Now, my field of expertise, I would say, are stock options and currencies, although this is the futures Japanese yen, and I'm a retail currency trader and do like the Japanese yen and the basket that I trade. But I wanted to bring up, if you're not marking out where to get in and at what price and how big your stop is and what your targets are, basically looking over last year on the yen futures, this would have had a $5,000 maximum risk in order to be able to trade three contracts at a minimum, as Jake's processes and mine also are trading multiple contracts. So we can get in and get up pretty quickly, get to break even, and hopefully have a bigger runner, similar to what we had running out here in September off to the end of the chart. And although these trades have closed out in this particular instance, and it is in a market I'm not actually trading. So in this instance, this is hypothetical information, but you can see it's had a winner on the buy, went higher. We had a sell that didn't fill, and then a sell that did fill and had a winner, and then a small winner on a buy. You can just see these results if you want to go through and all these results. And the spreadsheet that shows all the data is available. And again, if you're going to be trading, you have to have the setup trigger follow through, or rules to get in, rules to get out at a loss, rules for taking profit predetermined, back tested, ideally forward traded, and even third party verified. So I'm going to pop up to some of the trade examples again, because this is personal information on this. I'm going to show some expansion, contraction, buy or sell setups. So you can see at the top. Swing trades, although my swing trade setups are a little bit different from Jake's, the theory is the same. I learned how to code what I did from basically learning what Jake did. And again, if you're going to make it in this market, you may as well pin yourself to someone that already has and has systems that are rules-based, 100% objective, clearly defined, back-tested, forward traded, third party verified. Again, all of that information is extremely important, because obviously while you're here listening to us, you might wonder, is this reality or is it not? And everything is available if on request, if you have. So my basket, which is relatively small and may rotate, as you can see out of here, Apple, Amazon, Microsoft, which I have rotated out of on that from underperformance, NVIDIA, Qs, and Tesla. And of course, I'm happy to share rules for, say, rotation in or out. But basically, tech has been strongly trending. Here we go, as my cursor back. Tech has been strongly trending. We've got consumer discretionary. They were strongly trending. Obviously, one of the indexes on here. So at the time, because those sectors were strong trending by definition, that's the current basket. And the currencies have been the same since 2012 on that. And I've got results on systems all the way back to there. But let's pop the charts up on the very top left, because you've seen at least some of the basics on expansion, contraction. Would be nice to be able to see some results. So last year, Apple certainly did better than this year. I am using buy, sell on the stocks on here that I can show on the screens. And of course, I'm using options on these types of setups personally. As you can see, we had more winners on this one. We didn't actually have any losers, but I did mark out some of the divergence trades. There was a bullish divergence, as I mentioned, that triggered just prior to a buy setup triggered. And there it is labeled on the chart, missed being stopped out following Jake's rules on that by a few cents, and then went higher. So as you can see on here, net, we had Apple up. I'm just going to kind of go through these a little quicker on the interest of time. So here, as you can see, Amazon is in the top left on the Trade Navigator chart. Again, we can see that there are buys and sells, so the BS is on this chart also. And I did originally code the expansion contraction indicator in Trade Navigator, and then it has been since coded for other platforms. And at least a personal note on a side on that, I'm going to at least recommend if you have some coding requirements, contact me. I will connect you with Frank Castillo, who's just an amazing coder on multiple platforms. And I'm talking about being able to do high frequency trading systems fully automated on here. Amazon, of course, as you can see, had more losers than Apple, but was still up and didn't perform as well as last year on here. But as you can see, with the buy and sell setups, I've marked with the diagonal lines where the targets might be for target 1 or target 2, and then out on a reversal. And the rules are going to be here in the presentation shortly. Now, Microsoft, as I said, did really well last year, and as we got into a choppier jump and dump pattern, managed to finish out most of the last year towards the end with a drawdown, and actually finished out 0.13% up, so lost a little bit more right into the end of the year on this. So most of the pairs did see a little bit more gain out of all of this into the end of the year, but as I said, Microsoft, which had been doing really well, has managed to go into what we would consider a not trending pattern. And I have that by definition on the weekly charts, which is why I was saying I rotated out of Microsoft and have been replaced that with Palantir, PLTR, and that broke out strong up months ago. And also I've heard Jake making recommendations on that also. And so I'm like everybody else, I'm going to listen to the experts and verify for myself and then take my own setups off of recommendations. NVIDIA, so we're going to that list, 2023, phenomenal year. January through August was the big move on that. This last year, 2024, still did well. Did have a series of 3 losers in a row and did have 2 stop outs on here, but still net up. I'm going to be okay with the results as long as they haven't fallen, say, off the cliff as Microsoft did. And of course, then I just have rules of when to rotate out of underperforming symbols and rotate into. And to be fair, I'm really just looking at 1 or 2, maybe 3 of the top weighted stocks in strong trending sectors on that rotation. The Qs, so tech did not as well as last year, 2023, I should say the year before last now. 2023 did really well. 2024, still going to call this acceptable. So you can see we had more wins, fewer losses on that one. And again, since this is expansion, contraction, daily buys or sells, swing trades. There's a swing trade in here with a buy marker on there where price went up in an uptrend, reverted back to the mean or came back to average, triggers a buy setup, and then continues higher. So again, we have still wins more often, makes more than it risks on average. And then the last stock in that basic basket was Tesla, that started in the middle of last year to be pretty flat and even drop into a couple of losses in here. Managed to pop up and look really good and then go sideways and choppy and flat again. Finally, towards the end of the year, managed to pop out. So Tesla still ended out at about 13.64 on the gain. And again, this is taking 2% risk on that, and on these results, it's basically theoretically a $100,000 account with $2,000 risk, and these are share adjusted results on that. So I'm going to pop over at least to the currencies, because if you want to see some of the sell or buy type setup results, 2023, the Aussie dollar, I'm going to say this is relatively normal in the 4, 5, 6%. It may not sound super exciting, but if you are trading a basket and the total basket is still sitting in the, say, 60 to 80, maybe even over 100% for the year, I'm going to say that's still acceptable. What I did learn from Jake is to trade less. And I was going to say I was completely wrong. First system I got, I thought from Jake, didn't trade enough and looked to trade more. And then in all irony, came back around and said, okay, trade more is not necessarily better. It sounds like it should be, but it isn't. So as you can see on here, we had a better year in 2024. Ideally, we've got some bigger trending type moves where we can add to winning trades. And again, the Aussie dollar finished out at 20.17, managed to kick up quite a bit into the end of the year as that trend continued lower and targets down here were hit. So Aussie dollar, Euro Aussie as a retail currency trader, what I'd identified over the years of research were that the cross currencies have an effect that when, say, if they're normally correlated, the euro and the Aussie go up together, go down together. Yes, they're traded against the US dollar. There are times that they are not correlated, and say the euro's going up and the Aussie's going down. The non-correlated pattern generally tends to lead to a 1.6 times bigger move in the cross currency than either the euro or the Aussie in this case. So as you can see here in the euro Aussie in the past has had a 15,000 pip move, and it's attracted me in the past to have the potential to move big and sometimes in a very brief period of time on that. In fact, I've seen this go more than 100 pips in 15 minutes during the day. So again, it can be very volatile. And since I'm looking for growth in my trading, I don't need income. I am looking for growth, and I'm basically a long gamma option trader, if that makes sense. We're looking for big moves up or down in a really short period of time. And we do a fair amount of, say, fishing in the trades. And some really might be catching those trophy fish if we have some big winners in our results and all small losers. Obviously, we'll have some small winners in that, but we need to get some big winners. Something I did learn from Jake is that the big money's made in the big moves. And when we get that, that can lead to a fairly decent return. So we'll say euro yen is it's not the same as the year before. What's he finished out at 19.88, so made a little bit more on this into the end of the year. And I will say currently I'm in a bear trade, although that's off the chart here just a little bit into January. We've just had a sell set up, and that's in. So let's head down into the euro. Currently, at the end of the year, euro was in a really big move that has finally finished out. Euro 16.5 at the end of the year did manage to continue lower and create some more swing trades. So if you see, get a big trend and price pulls back, we'll get a reason to take a swing or sell. And basically, this is sell after a move higher at or near resistance and a confirmed downtrend. So again, we have the initial trades, and more in this case, it started off with a divergence trade, which quickly went down and hit multiple targets on that. So that was the result with the euro. I'm also going to pull up the British pound, which last year, different from 2023, started out with 4 losses in a row. So we'll say, at least statistically, with results over time, you can expect to get 4 or 5. Once there have been 6 losers in a row. And the drawdowns are still relatively acceptable, as you can see on a 2% risk. They're smaller losers when we do have losses, and relatively few full loss at 2% risk. So we have smaller average losses and can get some larger average wins. The British pound showing 7.68 here actually finished out 13.97 as it continued to go significantly lower into the end of the year after a expansion contraction sell trigger filled and got swing trades, and those have added on to cause the British pound to do better this year than not quite as better than last year, but certainly better than it's showing here currently on the chart. And out of the 12 on that basket, the last one here is the yen. Enough to say, over the years, one of the reasons I did the test in futures, a market I don't trade in the yen, is that the Japanese yen has been one of the best performers over the years, up, down, up, down. I'm going to say thank you, BOJ, Bank of Japan, for all of their basic decisions. And that's where we are on this one. It is actually performing Here we are, 31.87, so it didn't quite do as well as 2023, but consistent. And I will say, at least this year, the currencies finished out the year strongly, and that posted that the six currencies in the basket did a little bit better net than the stocks this year. And last year, it was just the opposite. Last year, the stocks did just a little bit better than the currencies. My comment here when you are trading is that if you have the capital to be able to trade more than one market, you do want to diversify. And ideally, we're going to trade non-correlated markets because one of the things we do know as systems traders is that our problems are going to be sudden reversals. Here we have a sell set up in the middle. It's a bear bar. Trades significantly lower. Fortunately, this with the rules was a limit order. Sorry, a stop order, not filled, but we'll get sudden reversals, right? A big sell set up, followed by price just going long. That's going to happen. So if sudden reversals we can't do anything about, we have to be okay with small losses when those. And the second thing we can do nothing about is consecutive losers. So statistically, and looking at large samples of data, as my background in the 80s was in Silicon Valley as a analyst, so as a reliability assurance analyst that was heavy in spreadsheets and databases. And so that's certainly where I've been able to pick up the process here on coding and tracking on that one, and then making improvements. And ideally, when you have the data, you can make improvements on the data and the spreadsheets, and or attempted improvements. I will have to say, a little bit like the Pareto principle in rules that are consistently profitable in thinking what may be better, is typically 20% of your decisions at what might be better than what you've got now may actually be better, and 80% not. But I'm still going to recommend always work on system improvement. And what did I miss? What could I do better? And again, this is the coach in me. That I'll have to say, for those that get this, as I'm going to pop up to the next set and the rules where you can take screenshots of these. But for those that do not follow rules, they're inconsistent. And as a coach, the one thing I see more than anything on the requests is I want to be more consistent. I want better entries and I want better exits. And of course, I can certainly remember being there once. And that's what led me to contact Jake and become a client because of his background and coding. So again, I'm leaving this on here because this is a strong buy setup. That would be the large green buys that you saw, and the rules that go around through this, including the entry, just a market on close on that. We're getting in just before the day's close on the rules with the moving average channel stop, which is one of Jake's rules. This moving average channel is the 10-period simple moving average of the high. And the stop is just subtracting the 8-period simple moving average of the low, which is Jake's moving average channel. That's what MAC stands for. And we're just multiplying that too. And that's what I am doing, is injecting some of Jake's rules into the entire process as you learn what, say, quote unquote works. You either use that directly or modify it slightly to meet your conditions. T1 is target one. It is the same as the max stop. So if whatever you've got here, let's just say it's $10 on a stock. Your first target is the $10 and set your stop to break even. T2, or target two, is 3 times target one for stocks, 2 times target one for the retail currencies, as the currencies don't trend as well as stocks historically on that one. And because you were seeing some Keltner channels on my chart, something Jake doesn't use, the reason I'm using them Chester Keltner's channels is that I want to know where price should be most of the time. And when the Keltner channels were originally defined, the 3 factor that you're seeing here should contain price most of the time. So if I've got a 3 times T1, or if today's high is greater than the extreme price range, then I do want to take some profit on there. And as you can see, there's some alternatives in here. As I said, note, if you are conservative, you don't have to go 3 times. You could go 2 times, as both of those have tested well. And again, I mean, coded back tests. And I'm going to say Frank Castillo again. He's my go-to for testing on that one because that's his expertise. So we're going to exit the entire position when Williams accumulation distribution changes from, say, an uptrend to a downtrend. Again, this is basically a Jake rule using Larry Williams accumulation distribution as a trend filter. If we are long and the trend changes, we would exit the position on here. And I do like very much to add to winning trades as soon as I've hit a profit target and get to break even. Now, even with options, that would mean if I am in, say, a call spread in an uptrend and I've rolled it over to cover the risk, then I could add contracts to that position and stay in and add time as long as the trend continues. So on that, since you're seeing the rules here, as far as what it might be for stocks, even for options, as I said, I really like stock options because of the probabilities. And again, for growth. So that's what I said earlier, is a long gamma type strategy. If you don't know what that means, just think of moves up strongly in a short period of time are great. Moves down strongly in a short period of time are great. How do we know if we're going to get it? Well, that's what we don't know when we take the trade, but we do know the setup. So if you had a chance to get through this, I'm going to go to the next page, which is just the week expansion contraction buy setup where price does not say close significantly higher. I'd like to be a buyer when price closes significantly higher in the upper half of the bar, and Williams accumulation says it's a bear trend. Then I've got some kind of a weak setup, and hopefully as I'm going to read through these less and less in the interest of time, but you should have your entry, clear order type on that, and also the stops and the targets and all of that. So I'm going to have to say I just looked at this buy stop limit, right? We want to get in above the price, about 0.5%, and that, and we don't want it to gap. So if it does gap, it becomes a limit order. If it doesn't gap and price goes up 1.005 above the previous day's high, or that would give us the entry on this weak setup on that one. As again, I'm always going with weak or strong, up or down, defined in order to help give better rules on this one. And as I said, they have been tested and optimized on that. The strong setup for sell, I'm going to read these less and less because it's basically just the flip side. You're going to see either the large red S's or some type of a sell trigger on that, or the bars just change color on that. And the weak Excel setup, and hopefully you're able to take screenshots. If not, and you want all these rules, I'm sure David will be more than glad to pass on the email, or you're going to see it at the end. You can contact Jake or I on that. And I will say Jake's rules may be slightly different from mine, and that's not necessarily bad. That just says we have slightly different styles of trading. And as you can see on here, I've defined in here Jake's swing trades in a defined uptrend. And today's low is less than or equal to yesterday's 8-period simple moving average of the low. Then that's going to trigger a swing trade on that. So here's Jake's swing sell. And I'm going to leave it on there for a few seconds for you to take a screenshot, or go ahead and ask us. I've also input my swing trades, which really want to see price come down to the 20-period simple moving average. I'm looking for, say, a slightly larger correction because I'm looking for having a bigger stop again and a bigger target, where Jake's process is going to take profit quicker on the swing trade. My swing trades get a bigger pullback and then are looking for another add-on trade with the same T1 stop, and is equal to the moving average channel width and 3-to-1. So again, I've got slightly different rules on that. Sorry about that. The swing sell, if you want to take a quick screenshot on that. And again, just swapping in here, we've got to have clearly defined setups and triggers. As STF at the end is Jake's setup trigger. Follow through, which I just also rewrote as when to get in, where to get out of the loss, when to take a profit, when to add to a position. And of course, these, in our case, are back tested And when I say liquid trending markets, in order to not to offend anybody's favorite stock, if it was like Bob's Pizza Parlor, not likely to be what we would call liquid. So high volume. I also scan for over 5 million shares, 20-day average volume. And because it's going to be an option trade, they have to have weekly options, and the open interest needs to be high for the strikes that we would trade on that. And I have no problem giving out the option strategies, which have been back tested to show which costs less and potentially makes more in the same time or less than other strategies. So again, a lot of back testing, and all of that goes into what can we prove. And I'll have to say what I like about what I do is that it is all entirely provable. As again, as I just pop back to the back test here in the yen, if I was going to trade in the futures markets, I would certainly like to know for whatever risk I was taking. Again, this was $5,000 risk for 3 contracts. If a trade exceeded the $5,000 risk, then it would just be a no trade. But I did want to pop up because, again, just to see how did your system perform in the past. This is not a market I traded, and yet I was still willing to back test it. Admittedly, because I've traded the the Japanese yen over time, already knew that this was going to do well. So we'll say that the Metastock Expert Advisor, which is a paid for service, is quite robust. As you can see in here, it will allow you to test divergences and buy sell signals, long-term, short-term on that. And when we just ran a basic test on the S&P 500, there's a reason why we see this graph here, 500 component stocks at the time. And this was a long-term test. We can see at the right edge, there were some stocks that lost net through that time, and the larger, I say losers comparatively. But with that break over here, we can see everything positive and green. There were more stocks that were up and a year that were down. And then the bigger winners were actually bigger than the bigger losers, and there were more of them. So sometimes just a simple graph with some of that data below. Sorry, pop right out of the presentation. And we're back at the end. Sorry about that. I clicked one too many, but there we go. Into the conclusion. Want you to be able to reach Jake. I'm going to have to say everything I've learned was founded by what Jake has done. And I just kind of took it to the next step for me and made it work for me. So literally, Jake #1, contact him at the top. There's the toll-free number. Also, as you can see, if you did want coaching, I would say call the 831-430-06000 at the top here. This is the number that would get you into Jake's office and schedule an interview if you wanted to do the membership or mentorship, I should say. So I did put the direct link in here on this if you are looking for coaching. And that would be with both Jake and I. So that would be futures and stocks, which are Jake's expertise, and mine are options in the stock market and retail currencies. So if you were looking for one-on-one coaching, we are taking interviews for this next year to do some, I'll say, group coaching, which also includes some one-on-one as you request. So Jake's contact at Jake at Trade-Futures. As a reminder, again, Jake's TradeOutLoud.com is just a fantastic resource. And although they're not all of my trades for the year, obviously I'm taking expansion, contraction, swing trades, and divergence trades, but seasonal trades, they're the ones you can pre-plan for. So basically in advance, say for this next month, or even for the whole doggone year, you can pre-plan out your trades. And at least know you have a certain number of positions, long or short, in the stocks that you can just look up in a search at seasonaltrader.com. It is still one of the best resources, and is utilizing AI and identifying the top choice out of many. So sometimes when you run through, say, a seasonal search, and that scan shows too many choices, or TMI, too much information, I know I'm probably more likely to do nothing if I have too much information. And so I like to keep it simple. I like to keep it specific. I like to have very few choices and basically become a specialist in a certain set of markets that are non-correlated with 100% objective rules that are chart-based, back-tested, say third-party verified, and I don't mind having audited information get sent out a lot. And so again, for both Jake and I, we're more than glad to help out any way we can. Expansion Contraction is at expansioncontraction.com and is free for most of the platforms. And if you were interested in checking out the Expert Advisor in Metastock, which is a paid for program, that is also available in order to help ease your decision making process of where to get in and where to get out at a gain or a loss. So that's about what I've got for the presentation. I know I'm wrapping up a few minutes early, but I did want to give David, if you're here, a chance to have some time in between calls and maybe answer some questions. So
Yeah,
David, are you
we
here?
have a
Ah,
yeah,
there.
yeah, we have a few minutes for questions. If anyone has any questions, go ahead and type them in the chat.
That could be for Jake or for me. Jake is here. He would have to type in the answer. And I'm putting you on the spot a bit, Jake. But again, Jake, 50 plus year of veteran on trading. And if you want to learn from the best, learn from the best, 100% objective, rules-based systems. And if we're going to get some questions in, either one of us are more than glad to answer, although I'll probably answer for Jake and then he can text in yes or no. Any questions? I see Omar said it's clear. Jake, can expansion contraction be used for day trading? Jake was asking that for everybody. Yes, expansion contraction can be used for day trading. I'm working on a high frequency day trading system right now because I do extensive testing, just past 2,000 consecutive trades as look for long-term stability. So admittedly, in that testing process that I learned from Jake, you've got to use a lot of data. Technically, go back 15 years if it's a daily type system, do a 10-year test and optimize that with your rules, and then work it forward for the next 5 years and see if the results are similar to the previous 10 years. And then you've got a back-tested, optimized, walk forward strategy. And it's that process where I'm saying, why am I at over 2,000 consecutive trades? You get to see how the data lays out. It's basically called distribution of data. And in that distribution of data, you want to see all small losses and some big wins and win more often. So ideally, when I spit out the statistics, it's from what I can prove from back tested and forward traded systems. So I do like to call it reality at the right edge of the chart. Expansion contraction will show you what is happening right now. And other going, Jake's even input on there. If you can't test it, don't trade it. So I would agree with that completely. There's a lot of programs out there that are exciting to see, even look tempting to try. But as Jake has said, if you can't test it, don't trade it. It should be programmable by a computer. That simple. And I'm going to steal it from Albert Einstein. Keep it simple and no simpler. I'm going to confess to being somebody that overcomplicates stuff. And in all irony, I find coming back to simple is easier to trade and less stressful, and typically clearer on that. And generally, when you add more, say, parameters into your rules, then you have a higher probability of seeing some erratic results. Now, on that, since we don't have any more questions, and I'm going to just go back with some experience in doing long-term, multi-decade tests. What I will guarantee you is that if you can't test it, don't trade it. If it has been tested, you will trade it. and expect some type of out of sample occurrence in the future because stuff happens. I'll keep it clean. And when an out of sample experience happens, it will, and you should expect it. So I may have, say, over 2,000 consecutive trades, and I know the good, the bad, and there is no ugly, which is great. I'm still going to expect over time that there will be some type of, when I say out of sample, in other words, say in 2,000 trades, it's never happened before. And now it has, and typically which would be negative would be a drawdown. So what I'm looking for are systems that have limited drawdowns and are growth oriented. And I'll have to say what I learned from Jake, the single one comment that was about the most important is the big money is made in the big moves, and learned how to identify a potential big move. I will say the pattern of all big moves is a strong trend, but the condition of a strong trend doesn't always lead to a big move. So when I have a loss, it's a breakout basic trade on a strong move, and it may just not continue. I just seeing on here, Jake's made another comment, 90% of the traders are losers. It's a fact. If you don't have 100% algorithmic rules, right, you're going to potentially be a loser. There are likely to be some kind of out of sample, or you're just, well, let's see, my first trading system I called whatever, because I actually just did whatever I felt like 20 plus years ago, 24 now, and quickly found that that was not consistent. So whatever doesn't work. You're right. You need to be 100% clearly defined, right? 100% objective rules on that one. As I said, back tested. If it's not testable, there's no way that we can prove that by continuing to trade it in the future, you have a better possibility of being consistently having a positive outcome. Also, still knowing an out of sample will happen. I have had that happen to me after multiple years in a consistently profitable strategy, how to add a sample occurrence, and caused a drawdown that I would consider unacceptable. And it just meant go back and rewrite the rules so that can't happen again. And that was back in 2014, and haven't had that problem in 10 years. So if we're going to be consistent, it's programmable. So I know we're close on the time, and I still wanted to give David a few minutes. So David, back to you.